Hello, everyone. Welcome to the market opening bell on Tuesday, October 14th, your 10-minute guide to the stock market. The Hang Seng Index opened 656 points lower, with losses later widening to 954 points, reaching 25,336. The decline narrowed by midday, closing down 400 points or 1.5% at 25,889. The Asia index fell 135 points or 1.5%, closing at 9,222. The Hang Seng Tech Index dropped 114 points or 1.8%, closing at 6,145. Total market turnover was 490.3 billion Hong Kong dollars, the highest since April 7th. Southbound funds recorded a net inflow of 19.8 billion Hong Kong dollars into Hong Kong stocks, including Net Buys Tracker Fund at 7.282 billion, HSCEI Index ETF 2.135 billion, Hua Hong Semiconductor 1.348 billion, Xiaomi 888 million, Meituan 806 million, ZTE 724 million, Kingsoft 286 million. Net sales Tencent at 2.445 billion, Alibaba at 1.624 billion, SMIC 523 million, Innovent Biologics 515 million, WuXi Biologics 267 million. Statistics show southbound funds have net bought Xiaomi for 6 consecutive days, totaling 4.708 billion. Net bought ZTE for 3 consecutive days, totaling 1.672 billion. Net sold SMIC for 3 consecutive days, totaling 5.628 billion. Net sold Alibaba for 3 consecutive days, totaling 4.184 billion. Net sold Tencent for 3 consecutive days, totaling 3.859 billion. U.S.-China trade tensions ease. U.S. President Trump posted about U.S.-China relations, stated that both he and Chinese President Xi Jinping do not want China to face a recession, emphasizing that the U.S. aims to help, not harm China. This is interpreted as an attempt to de-escalate tensions. Last Friday, U.S. markets fell sharply due to Trump's proposed 100% tariffs on Chinese goods. China's Ministry of Commerce clarified that rare earth export controls are not bans, and compliant applications for civilian use will be approved. On the tariff war, China's stance remains consistent, unwilling to fight but unafraid to do so. Regarding U.S. port fees on Chinese ships starting today, October 14th, China's Ministry of Commerce spokesperson stated that the U.S. move violates WTO rules and the equal reciprocity principle of the U.S.-China Maritime Agreement, calling it typical unilateralism. China has expressed strong dissatisfaction and firm opposition and will impose special port fees on U.S.-related ships as a necessary defensive countermeasure. Technically, the Hang Seng Index briefly fell below the 50-day moving average to 25,800, but closed above it. Whether it can hold this level remains to be seen. A 352-point downside gap appeared yesterday between 26,247 and 25,895. Without negative news in the short term, part of this gap may be filled. On Asia markets, the 3 major Asia indexes fell 1.3% to 3% in the morning, but narrow losses by the afternoon. The Shanghai Composite closed at 3,889, down 7 points or 0.2%. The Shenzhen Component fell 123 points or 0.9% to 13,231, and the Chinex Index dropped 34 points or 1.1% to 3,078. Total turnover in Shanghai and Shenzhen was 2.36 trillion yuan. The US dollar renminbi central parity rate rose 41 points to 7.1007. On China trade data, September exports in US dollar rose 8.3% year-on-year versus market expectation of 6.6%, and imports rose 7.4% versus 1.8% expected. China's export structure continues to optimize, with industrial robot exports up 54.9% and wind turbine exports up 23.9% in the first 3 quarters. Trade with Belt and Road countries grew 6.2% to 17.37 trillion yuan, accounting for 51.7% of total trade, up 1.1 percentage points. Exports to ASEAN, Latin America, Africa, and Central Asia grew 9.6%, 3.9%, 19.5%, and 16.7% respectively. Trade with APEC economies grew 2%. On smartphone market, a counterpoint report shows a 2% year-on-year decline in China's smartphone sales in the first 8 weeks of Q3 2025, with the full quarter expected to see a slight drop. Weakness in the smartphone market has raised concerns about consumer electronics demand, including Apple products. Hong Kong Apple-related stocks fell, with Foxconn Technology down 7.9%, Lens Technology down 6.1%, and Sunny Optical down 5.5%. Xiaomi dropped 8.7% intraday, closing 5.7% lower at 49.08 Hong Kong dollars. Reports indicate a suspected Xiaomi SU7 Ultra crashed and caught fire in Chengdu, Sichuan on October 13. Videos online show 4 people attempting to open the vehicle's doors and windows without success, with the car severely burned. On earnings, Smoore International reported Q3 revenue of 4.197 billion Hong Kong dollars, up 27.2% year-on-year, a record high. Adjusted profit was $444 million, up 4% year-on-year and 4.8% quarter-on-quarter, driven by revenue and gross profit growth. Operating expenses, including distribution, sales, admin, and R&D, grew slower than revenue. The flagship series launched in first half 2025 performed strongly, expanding the consumer base. Localized operations and tailored marketing in key markets boosted brand share and known brand revenue growth. U.S. Treasury Secretary Scott Bessent said efforts are being made to de-escalate tensions, with Trump set to meet Xi Jinping in South Korea. Easing U.S.-China tensions lifted U.S. stocks, recovering most of Friday's losses. The Dow rose 587 points to 46,067. The Nasdaq gained 2.2% to 22,694, and the S&P 500 rose 1.6% to 6,654. The Nasdaq Golden Dragon China Index jumped 257 points, or 3.2%, to 8,275. Tech stocks rebounded, with Nvidia up 2.8% and Tesla up 5.4%. OpenAI announced a partnership with Broadcom to develop 10 gigawatt custom AI chips, starting deployment in second half 2026 and completing by 2029, boosting Broadcom by 9.9%. Financial stocks performed well, with Goldman Sachs up 2.9%, JP Morgan Chase and American Express both up over 2%. On commodities, spot gold broke about $4,100, hitting a record $4,107.41, up over 2.2% intraday. Spot silver surpassed $52 per ounce, also the record high. Looking ahead, Fed Chair Powell will speak on Wednesday. U.S. earnings season begins with financials like Goldman Sachs and JP Morgan and chip makers ASML and TSMC reporting quarterly results. Our stock pick today is Xiaocaiyuan, stock code 999. Xiaocaiyuan primarily operates the mass-market Chinese casual dining business in China, focusing on the 50 to 100 yuan per customer segment. It plans to steadily expand into the sub-50 yuan market, aiming to provide affordable, home-style dishes and attentive service. positioning itself as China's widely recognized family kitchen. As of June 30, 2025, the group operated 672 stores, a net increase of 55 stores from 2024, with 291 in Tier 3 and below cities, 109 in Tier 1 cities, 192 in new Tier 1 cities, and 80 in Tier 2 cities. For the 6 months ended June 30, 2025, revenue reached 2.713 billion yuan, up 6.5% year-on-year. Dine-in revenue grew 2.2% to 1.647 billion yuan, driven by an increase in operating stores, while takeout revenue rose 13.7% to 1.057 billion yuan, fueled by a rise in takeout orders from 12.8 million in first half 2024 to 16.8 million in first half 2025, attributed to expand store networks offering takeout services and enhanced appeal on online platforms. The group continues to optimize operational efficiency, strictly manage costs, and deepen refined management, steadily improving profitability. In first half 2025, net profit attributable to shareholders was 382 million yuan, up 35.7%. Adjusted EBITDA reached 646 million yuan, up 42.3%, and net cash from operating activities was 764 million yuan, an increase of 309 million yuan year-on-year. Looking ahead, China's socio-economic landscape is undergoing complex changes. Stable urban disposable income growth supports demand for mass market dining. Rising urbanization drives dining demand, and demographic shifts favor low ticket sub 100 yuan dining. Against this backdrop, the rapidly growing mass market casual dining sector, catering to the rigid and increasing demand for delicious yet affordable meals, offers significant scale and growth potential, providing a favorable environment and opportunities for the group's continued expansion. Recommended buy price 10.3 Hong Kong dollars, target price $11.5, stop loss $9.8. I do not hold the aforementioned stock.